by Chris Bates and Ben Sum from Blusk. Many of you will know Chris from the Australian Property Podcast, The Elephant in the Room, and just getting around and sharing some of his wisdom with the community. But Ben's new to many of you, definitely not new to me, because this is the dynamic duo that helped me get into my first property. These two guys right here work wonders for me. Not that you should have to work wonders, but you guys definitely did for me. So we're going to be talking about property today. We're going to be answering your questions. I can see a question from Norm already about buying off the plan. So we will be answering a few of those. But maybe to get started, Chris, maybe we'll start with you. Left your screen for me. So can you just tell us a little bit about yourself, mate, how you got into property and so on and so forth?
Yeah, I mean, I'll keep it pretty short. Started as financial advisor back in 2007. I actually met Ben in 2011 when I was an advisor. He was a power planner. We stayed mates. I actually became a mortgage broker back in 2013 and started Blusk back in 2014. But in 2012, I shifted from working a lot of older clients to younger clients. And then younger people, families, couples, singles, their biggest challenge is property. And so since 2012, we haven't really worked with older clients at all, and it's just guiding them through their big property decisions. Ben joined the business over 5 years ago, so Ben runs the whole back end. I won't steal your thunder here, Ben, sorry, but that's sort of how it works at Blusk. There's a big team of us now. There's 17 of us, and yeah, it's good to chat.
Yeah, great. So Ben, first time caller, long time fan. You've been in the business with Chris for a long time. Tell us a little bit about yourself, mate.
So hey everyone, I similar to Chris started in from a planning side of things, working on the strategy side of things as a power planner. Have probably worked and involved in probably over 5,000 financial plans over the career.
Wow.
I think 5 years ago decided to make the move and work solely, I guess, with younger clients and from a lending side. And yeah, it's been an amazing journey.
Yeah, great.
Yeah.
Okay. For those people that haven't been through Blusk, Ben's work ethic is something to behold. He would be calling me on a weeknight saying, "Hey, mate, just so you know, this is available. So you should probably check this out." So great to have both of you joining me and everyone today. So. As I said, we're going to go through a fair bit, and we are going to answer some questions. So I'm just going to quickly put this disclaimer on the screen here. Obviously, we don't know your full circumstances, so we can't give you any type of personalised advice or service today. However, you can reach out to the guys from Blusk I'm sure we'll drop a link in or something like that. I think there's actually a link below the video, depending on where you're watching on LinkedIn, Facebook, or YouTube. So you can get in contact with the team there. We've chosen to partner with Blusk because I've had such a good experience with the guys, and I trust them with my affairs. So that's why we do this together. But I'll take that as read. So on today's agenda, we're going to talk a bit about the property market. I'm going to stick all of us down the bottom for a second. We're going to talk about the property market. We're going to talk about some of the strategies. Ben's going to walk us through a few of those. The opportunities, I guess, and the challenges for upgraders, people who are looking to move into their next property, whether you're in a family situation, a single or a couple. What's the next step for investors from here? Because interest rates are higher. What does that mean for us? And then finally, homeowners, we might actually start with a piece on this because, Chris, you did, just really quickly, I'll try and get rid of my screen here. You did write something yesterday about, and it was pretty popular on LinkedIn, about homeowners struggling, I guess, and the kind of fear that's available or on display right now for anyone that owns a property, right? So can you maybe just walk us through some of that and how you think about where people are at right now, what you're seeing?
Look, I think it's a not one property market, right? So anyone listening, media stories or the news is always talking about the Australian property market, or they might dial it down and talk about the Sydney market, but the market's made up of thousands of sub-markets. And we'll talk today a bit about first home buyers and investors and upgraders, and everyone's sort of having a different experience, right? And I think the big fear at the moment, though, is higher interest rates was going to crash prices. That's what the 2022 story was all about, right? big Chris Joy came out, done really well forecasting in the past, was saying 15, 25% falls. All the banks were forecasting huge falls, but no one really expected the property market to be as resilient as it was in 2022, right? Interest rates went up 4%, like a rapid fire. As a homeowner, I actually upgraded in just before the first interest rate increase. I wasn't expecting them to go up so fast, right? No one was, no economists, right? And so, but even though rates went up 4%, borrowing capacities, how much you can borrow from a bank's fallen over 40%. The Sydney market fell 10%, and then everyone got surprised that we could see it as brokers back, October last year, that buyers were like, you know what, I really want to, I'm a first-time buyer, I really want to enter the market. I need to, I've got a demographic need. I want security and I want to own a property. And also opportunistic upgraders were starting to come to us. And the mentality shift was coming, and we could see that buyer urgency was increasing. And so even though the media story was saying the market's falling, that's not what we could see as brokers, the behaviors that buyers were displaying. And all you saw coming into 2023, even though rates were going up, you could see support in the property markets across our capital cities, and prices starting to increase, right? And this was coming in, so this just goes counter against what should be happening. Rates are going up, right? The reason for that is that when there's uncertainty, people decide to potentially not take action. And so listing numbers, people deciding to sell really fell off a cliff, especially that, if you're in a good property. So good properties just really died out of the market. And so a drop in listings, a drop in people selling sort of was offset by this drop in demand. And there was still enough people out there willing to sort of be opportunistic to see it as a good time. So coming into sort of May, that was the overall arching. So we could see there was quite a bit of steam in the market, which is hard to believe when, rates were still rising. Back in May, there was a belief that maybe we're done with rate increases, right? It was at 3.6. Everyone got surprised a little bit, but the market's been flipping back and forth on interest rate expectations almost daily, and weekly, definitely. And that last couple of rate increases, especially that 4% number, I think has scared a lot of people. And there's also the expectations that rate cuts are going to be a bit later, right? And so people are like, oh, maybe this is a bigger storm than I thought. I think that's done two things. I definitely think it's slowed down buyers entering the market. Their borrowing capacity's fallen another 5%. And they're a little bit more nervous on, should I buy now? Because that fear is starting to, and that's a window really of opportunity, really. That's what you obviously want. But it's also said to people who are thinking about selling the second half of the year, homes, I think and upgrading, I think they're going to say, look, I'm not deciding to sell. Now, I know this is a long answer to the question, but there's a lot of talk right now that listings are starting to increase. And what we're saying is two things. The homeowners absolutely don't want to sell. And this is what the presence of the article was yesterday. The clients of ours that, it's only a small subset that have got big mortgages that have bought in recent years. People who bought 5-10 years ago, they're on top of their mortgage. It's a small, their incomes have gone up. They're not really a problem, especially the ones who have bought longer than that. So those ones who have bought maybe 2020 onwards in particular. So those people are starting to batten down the hatches. The people who have taken out bigger mortgages have actually had pretty big wage increases, to be honest. But a lot of there is definitely a subset that have taken on mortgages that they can't refinance. And they're doing everything they can to stay in their homes. And I think that has definitely gone up a lot, which you would notice as well, Ben, with our clients. There is definitely a bit of a fear of what can they do with their mortgage, and then when that's what that article was about is, coming out with alternative ideas rather than selling the home, because it's not a great situation, because what you're trying to do there is you're basically gambling with your home, which is your security and stability particularly when you've got a family. That's really important. If you do sell, you've got selling costs. You probably haven't got much money, because the reason you're selling is you've got a big mortgage. So you probably haven't got much equity. Then you're going to have a little bit of money in the bank account. Yeah, then you've got to go on rent in a rental crisis. That's not going to be great. You may or may not be able to move back in with family. But the sentiment can flip. Just like it's flipped in the last 2 months, it could easily flip again if global story around inflation starts to subside. The US has got under 3%, Canada going back down in New Zealand. What happens if we start getting much more positive on, inflation coming down in the next few months? And does that then mean rate cuts are coming sooner and later? And does the sentiment shift? And you could really then go, wow, I've just gambled. But then the issue with that family or that home buyer is they might not be able to rebuy into the market because borrowing capacities are lower now. They'd have to pay stamp duty again. And what ends up happening is you can basically miss out on the market recovering. And we've seen that in the past for clients. And so homeowners are doing that. But if they've got an investment property, which is usually investors have usually got a home, like it's typically they try to get a home, but there are sort of younger people with investors. They're absolutely really under pressure because they haven't got a lifestyle need in that home. It's easier to cut ties. And it makes much more sense to cut ties with that property. And so we're seeing a real increase in listings in investor hotspots. And typically investors go to places where positive cash flow, it's a lower price point. That's typically because they feel like it's less risk. It's actually potentially, we believe, more. And we're starting to see listings really increase. So that's definitely a bit of a warning sign in the market.
I was going to ask you, Chris, about that because someone did, I can't remember who it was. I think you guys might have covered on the property podcast. Still got the logo in the top corner. I should probably maybe just drop that away. But there was someone came out with some research recently that effectively said, listings seem to be going up. And then I think it was maybe a conversation you had with someone, like with the person who came out with this, that basically shows that the properties that are coming onto the market that are available for sale nationally seem to be those ones where it's not the typical clients that you deal with, where they're looking for homes or high quality assets, so to speak. Maybe just talk that for a sec.
Yeah, high quality assets are driven by the owner-occupier market. It's right. It's driven by people trying to buy long-term security and lifestyle benefits, right? And so that goes against that. Firstly, you're right. Kent Lardner, a friend, I said to him, "What these listings are going up, but where are they?" And he sent me basically the graph and showed me that there's huge increases. 200-300% increases in outback Queensland and outer skirts Brisbane and Adelaide. There's a bit in Perth as well, to be honest. So that's where the listing problems have been. But this is a story to watch very closely because listings can lead to having more stock on the market, which is like another property acronym would probably be inventory, right? And if buyers feel like there's lots of choice and there's no urgency, what do? You sit and wait. You don't have this pressure. This FOMO to buy. It's the same sort of stock markets when prices are falling. You don't buy in because you're like, well, prices are falling, right? And you get this spiraling effect, more listings and also potentially more people can afford. So it's going to be a real watch of, and this is the thing with property markets, it's micro markets within a macro story. And so what could be happening in that part of Sydney, Brisbane, could be completely different to what's happening in this part. Markets move in different cycles. Houses can move different to apartments, etc. So I've already chewed up 15 minutes of today. So let's keep
I might just chuck one over to Ben. We're going to talk, Ben, in a minute about first home buyer type things, but there was a question, and this is just a very vanilla question, and it's a good one that comes through from Anne. It's just talking about like where are rates sitting at the moment. So she said that there's a variable component on a loan that she's seeing is 6.13%. Now, obviously, we're not telling her what to do, but just generally, like where are you seeing rates as someone that's dealing with heaps of clients every day? Like where are rates falling at the moment?
So I wanted to preface by noting that most of the banks have recently changed their pricing strategies just in the past month. So even though there was recently a hold of rates in July, but you'd probably find that the rates that can be achieved currently are going to be worse off than the rates were achievable in June and in May.
So they're still increasing. Is that what you're saying?
So the cash rate hasn't increased, but the banks have reduced the discounts that they were offering. And I believe that's because they're trying to be accountable to their shareholders because the bank's net interest margins are the lowest that they've been in a very long time. And that net interest margin, just to explain, is the difference between the loan rate that they're lending out at and the high interest savings rate. And I think it's a good, quick predictability of future profit.
Yeah.
So the net interest margin is the lowest because for a home loan, rates are probably in the 5.8%. And with a high interest savings account, these days you can get like a honeymoon rate for 4 or 6 months at about 5.5%. So you can imagine that margin is quite low at the moment. And so I think the banks have got onto that. They've been competing fiercely with each other to kind of cannibalize each other's business over the past 12 months. And then when it came to the time that they had to report on their profitability and future profitability, shareholders didn't react too well. That net interest margins were down, and so the banks have said, all right, we're going to change our pricing strategies, and they're not pricing as hard as they were about a month or 2 months ago.
So does that mean, as a broker, you're seeing this play out? Do you have options outside of just the standard names?
Yes, definitely. But I think all banks and lenders are facing the same issues in that the cost of funding has gone up. And I think, I think pre-COVID, there were a lot of non-banks or lenders that were pricing harder than the majors because the cost of funding was low. But I think currently in the current market, I think the cheapest cost of funding is from bank accounts and savings accounts. And the banks that have the biggest access to that are the major banks. Whereas, non-banks and second-tier lenders, they pretty much usually have to go on the second-tier money market, and their cost of funding is higher. So you actually find that currently, non-banks and lenders are pricing it higher than the majors.
Right. Right.
So at the moment, I believe it's the majors, and certainly from my experience, the majors are pricing the most sharply, and they are also the banks that are pricing the existing clients the most sharply.
Right.
So I guess I will preface by noting that if you had a rate, or if you had requested for a rate discount from your bank in sort of that May period, you're probably going to be on a rate, depending on which bank you're with as well. Some banks price their existing clients just as well as they price new clients. But potentially you could have a rate that is lower than what you could achieve as a new borrower currently.
Right. Okay.
But just to give some rough ideas, I think as an owner-occupier loan, a competitive rate would probably be in the 5.8. And as an investor, with an interest-only rate, it's probably going to be 6.3, 6.4, 6.3 to 6.5, I think is a competitive rate. So that rate that Anne, you've noted was 6.13. If that's an interest-only loan, that is actually a very competitive rate. You wouldn't be able to achieve that currently in the market with most of the major banks.
Yeah. Right.
Now, if it's principal and interest, that's usually about 20 to 30 basis points lower than the interest-only rate.
Okay.
So if that was a principal and interest rate, it probably is still quite competitive.
Yeah, great. And g'day, Jennifer. So welcome to the live stream. So Ben, we deal with at Rask, and you guys deal with this a lot, is like first home buyers or even upgraders that have young families and so on and so forth. But like we've seen a lot of things in the media, like New South Wales most recently, with incentives around first home buyer schemes, to get people in the market, whether it's stamp duty or borrowing capacity, these types of things. Can you maybe just give us a high level overview of what you're seeing from your clients coming through? And if we just keep it to the East Coast, because we probably don't have time to go through every state by state, but predominantly the East Coast, which is where we see most of our viewers and listeners.
Yeah, absolutely. So I think probably the most obvious ones are the stamp duty concessions for first home buyers. And pretty much across the 3 states, below a certain price point, there won't be any stamp duty. And that's obviously a large portion. It's usually about a 5% cost. So it is a substantial cost. In New South Wales, buying below 800,000, you'll be exempt for stamp duty. In Victoria, 600 grand, and in Queensland, 500 grand. And pretty much it will reduce in New South Wales. It will reduce it will cap out at $1 million. Victoria 750 and Queensland 550. Right. And I think on top of that, I think the government has been aware that I think as a first home buyer, it has been quite challenging to accumulate a deposit to get into the market. So there are a few schemes that help with that. There's the first home loan deposit scheme, and that's where the banks are willing to act as a guarantor for you. And because of that, the banks are happy to lend up to 95%. And so that means you just need a 5% deposit.
Right.
Yeah. So I think that's a great scheme to take advantage of. There are limited spots in the market, so it is one that if you are keen, it probably is. It does make sense to check if there are any spots available. They do refresh on the 1st of July, so given that we're still the new financial year just started, that would be the most spots available currently. And yeah, that would be a good one to take advantage of.
I remember when I went to look through this and I spoke to you about it. I remember you said like there were only certain lenders and it was only a certain amount of time, but it was July 1. That's not why we're doing this webinar. It just happens to be coincidence, which is really good. But is it, if I'm not mistaken, Ben, just one follow-up here, there are some limits on that 5%. Is that correct?
Yeah, so it is 5%. So it is meant to help first home buyers get into the market. So you need to have a minimum 5% deposit. But typically, if you've accumulated more than a 5% deposit, I guess the banks and the government, the scheme is meant to help buyers get in the market, not meant to be taken advantage of, I guess. So what I mean by that is if you've accumulated a 10% deposit, then the banks will lend to you up to 90% rather than at 95%, so they can take advantage of that scheme.
Yeah.
And I think the only other thing to throw in there, it's just there's an income limit. I think it's 120 for a single, 200
Correct.
for a couple.
Okay.
And there's also price point limits depending on where you're buying as well in terms of the different states and things like that, which you probably wouldn't achieve anyway on those incomes. So it's not everyone's available to it. Yeah,
that was one of the things that I noticed. Like in here, because I'm in Melbourne. By the way, everyone, I'm in Melbourne. Ben's in Queensland, and Chris is in New South Wales. So we're kind of all over. But I remember in Victoria, there's like the Mornington Peninsula, and a lot of the houses down there where we were looking were slightly above the limits that we could use for something like this, which makes sense, right? Because they shouldn't let you just go and buy a $10 million mansion and just max out your line of credit or whatever. But it makes sense. So there's plenty around for first home buyers then to consider. And obviously it's a bit of a interesting one. Like you need to speak to your brokers to get on that. So I did see, so Jennifer, you did ask about your thoughts on the first home guarantee, which Ben just spoke to. So worthwhile speaking to your broker about, Jennifer, by the sounds of it. There was another, there's a lot of questions. So JD, you did ask a question earlier on. We might jump to that, which was, I'm currently looking into property investment and wanted to pick your brains on interest-only loans in this current climate. This would be my first investment property. And maybe Chris, because there's a question he's followed up with as well, which is what's your take on the rising popularity of bankers over brokers for securing home loans? Or maybe it's brokers over banks, because I think it might be the other way around.
Yeah, I mean, the investment interest only on investment properties makes a lot of sense. The banks definitely made it more harder to get interest only investment properties, especially on higher LVR loans. But I think that's a lot relaxed now. You can get 90% interest only pretty easy now, Ben, right? Through banks. And so, if you can get interest only on investment property, it makes sense. I mean, because the interest is tax deductible. That small extra interest cost means you can build buffers, whether it's built for adding value, doing other investing. You want to keep your tax deductible debt on investment properties as high as possible. So, and it shouldn't be any issue. There is potentially a servicing reduction on that as well. So just to be conscious that, potentially you might be better, you don't need that servicing. This is the big thing for first home buyers. So first home buyers, we're finding, we love helping first home buyers. It's an amazing experience for us to get someone through that journey. It's so stressful, and just to even think and talk it through in their life, etc. But the challenge we're seeing for them, no matter what income they're on, to be honest, this is all relative, is they haven't got enough capacity to do what they want to do. And it's a real battle. So they're having to make compromises because their borrowing capacity has fallen 40% like everyone else. Property prices haven't fallen 40%, right? And so even though there's this prices have gone down, well, their options have actually reduced quite a lot as well. And so it's a real capacity problem. But the challenge is that do you wait for more capacity, which could be a higher income, or it could be that interest rate cuts, or it could be that APRA steps in and reduces the serviceability buffer. Interest rates cuts and APRA are probably going to happen when the inflation's under control and there's much more positive outlook, right? That's not going to be great for property prices. That's going to be a real support. So if you wait for those, you're probably going to pay more. If you wait for a higher pay rise, that's definitely an option, depending on how long it's going to be and how significant it is. If it's 5 or 10%, well, it's not going to change the game. If it's quite significant, or so you're buying, we're seeing a lot of singles, even if they're reasonably new in a relationship, there's always that, moment, are we in this, are we not? But if they are, combining resources, because if they do it alone, their options are very limited. If they do it together, opens up a lot of options for first home buyers. So we're seeing that. This first home buyers absolutely want to enter the market. Yeah, they want to make sure they can afford longer term interest rates, but they have a lifestyle goal and a demographic need to, whether it's a couple or a family, and they want to enter. So we're still seeing a lot of people come to, but they're having a borrowing capacity restraint. The bankers over brokers, it's definitely the other way. I mean, brokers started in the early 2000s, there was a 1% market share. When I became a broker, I think it was 40% market share. Now it's 70 plus. And there's a reason for that. There's no cost to use brokers, really. We get paid by the banks, and we've got access to every lender. We've got access to every lender's policy. And even if you've got the private banks, we stole a big client from CBA Private this week, because of the flexibility we offer him versus even the private banks. And so, there's not really brokers are winning the war against banks. Unfortunately, if you were thinking bankers were winning it over brokers, but I reckon you just got it the wrong way around.
Can I just add one more thing to that? I think even from a compliance perspective, a broker is required to act in the best interest of the client, whereas that best interest duty does not apply to bankers because they can't. They can't act in the best interest, given that they can only consider one product and one bank. So that requirement doesn't fall on bankers, but it falls on brokers. And I think that's played a part in why brokers have been more popular.
Yeah, and I just just for JD did say got it the wrong way around, so thanks for the answer, guys. But I just put a link in the chat, JD, for a podcast that we did recently, Chris and I actually, where we talk about the mortgage broking process and why, to what Ben was saying, brokers are out and out winning. Because I got to admit, personally, I was quite hesitant with brokers in the beginning. No offense, guys, but seeing the proof in the pudding and seeing the whole industry swing heavily to broking, I can see why that's happened. Okay, so there were quite a few questions coming through, but one of the things that I wanted to talk to you guys about was also property investing, which is more on JD's first point. How is it going at the moment? Chris, you mentioned serviceability and capacity for first home buyers, but how are you seeing that, pardon me, with investors?
Look, it is crazy how tight borrowing capacity is, right? We're talking 4 to 4.5 times your income. Now, to give you a bit of context, when I started in broking back in 2013, coming from financial advice, I was doing borrowing capacity calculators, and I was scratching my head going, surely this isn't possible, right? Surely we can't borrow 12 times income. Sometimes even more than that. It was ridiculous. There was so many little problems with bank servicing calculators as well. You could there's lots of different strategies to maximize capacity, etc. So that's not the world. That's when people were able to build big portfolios of properties really easy, because you could leverage your income so far. Look, now it's really hard for property investors, and a lot of property investors have got a property, and so then it's a case of have you got enough capacity to get a quality asset? And a lot of investors as well, they do enter markets at the wrong time. It's just human behavior. In share markets, it works exactly the same. Investors are usually, the first time investor usually enters late, right? The crypto grade, they enter late. It's the dumb money follows the smart money, and the smart money leaves. And there's a whole behavioral cycle here, right? And so a lot of investors will invest when they think prices are going up, right? So we could see that, late last, early this year as well. And so there's not many investors coming into the market. And if they are, they've got capacity issues. The big story right now is really what current investors do, because there's about 3 million investment properties, right? And do they start having to sell, and and they're selling in a rental crisis. So are we going to get bigger rental issues? Because if they sell, they're more likely not to sell to a new investor. to be honest, it's probably going to be to a home buyer. So there's less rental stock. So, but the challenge with investors right now is that when you want to buy, though, is when there's fear in the market, when you can get better buying opportunities because owner-occupier demand is not through the roof. And so if you have got great capacity, it's just the cash flow cost is quite high at the moment, but you've got to really take a longer-term view and go, well, yeah, I'm willing to sacrifice a bigger cash flow burden right now because I know it's a quality asset that's driven by the owner-occupier market. And I'm making a bet longer term that rates aren't going to be sustainable at higher rates because then you can justify the lower cash flows. So you do have to be a lot more strategic in where you buy. And yield probably matters slightly more because of the cash flow burden. But, property is driven by capital growth. So you definitely want to, almost 99% focus on that, I believe.
There's actually a question that came through from Selena. So we could probably just touch on this briefly here. And it came through a little while ago. It was from Selena, who owns a unit in New South Wales, but would like to buy an investment property to take advantage of the rental demand. So you just spoke about the income. Maybe you can talk about that again, Chris. And Ben, feel free to chime in here as well. But how do I access and use the equity in something like that to start investing? Just even general thoughts, because that's what we're here for. Just general thoughts. Chris, Ben, what do you think?
So, Selena, I'd always slow you down here. Anyone is like, before you think, I can take advantage of an opportunity, there's always potentially an opportunity cost, right? And what you'd want to really do is go, okay, I've got a unit. Am I going to live there long term? Is this, going to suit my family long term? If you've got a family or you're thinking about having a family or you've got a partner or you're not, or you're going to move for work, etc. Because one of the consequences of investing more is it basically eats up your borrowing capacity and it may stop you doing something from a lifestyle point of view. Secondly, you might actually be better, depending on the unit you've got. It could be a high-density apartment in a location where they're building lots more apartments. You're actually better to potentially sell that and buy a better asset than go and buy an investment property. And, because your home's your biggest opportunity in terms of it being CGT-free.
I was going to say the tax-free benefits, yeah.
Yeah, so it's taking advantage of potential rental environment. It's not really, rents have gone up, right? Maybe 20, 30%. It's crazy, right? But interest rates have gone up a lot more than 20, 30%. And so even though rents have gone up, your cash flow cost has actually gone up a lot more. And even if you get a tax deduction and, et cetera. So, yeah, but it's really a case of probably thinking through your personal situation, what your plan is, and does an investment probably make sense at all for you right now? Or should you actually wait? And Chris, it's a detailed question. And getting access to equity is really easy. So, a bank will value a property. You will generally order it with multiple banks because they can be quite a big variance. You may have to state your current lender because it's fixed, or you may want to, but, then we can basically get a valuation, borrow up to 80% pretty easily if you've got the income to do so. And then that money will just sit in an offset account. They're ready to go for a deposit whenever you purchase something. So it's a really simple process getting it. But I'd sort of take a step back before we go forward.
Yeah. Just quickly follow up on that, Ben, maybe just a quick question. Does it really matter if someone has an apartment for redrawing equity, or does that not matter at all, like versus a unit versus a home, like a house?
I think it depends on the particular security. So you're right in that, for example, if that you had a unit in a high-rise building block, there may be LVR requirements that are stricter than if you had a home. An example is, for example, if you purchased, let us say a 90% LVR, and if you wanted to release equity, potentially you could do that via your existing bank and reuse the equity, reuse the mortgage insurance that you previously paid, and borrow back up to 90%. Now, and release that equity back up to 90%. But if you're in a unit, and it could be for various reasons, one of them being that the bank might actually hold security over several units within the same building, and they've said that we've reached a point where we feel that we've got too much risk exposure to this particular building. We're going to limit LVRs, or we're going to limit borrowing on this particular building. And so they might say, well, right now we're only going to consider 70%, or we're not going to consider any subsequent lending. So that's where it might change.
That's something that I never knew about until I spoke with you guys. It's like the banks also have to think about their risk. Like, how many homeowners or investors do they have concentrated on this one area? And that can impact things you don't know in advance, right?
Yeah, absolutely. Depending on the bank, they've got like a list of postcodes that they don't want any more lending on, or a 80 or 70% investment limit. If it's a smaller apartment under 50 squares, that can be issues. It's under different like company titles and community titles and things like that. So yeah, you definitely need to and that affects demand, right? If someone can borrow a lesser amount on your apartment, then you basically rule out people with low deposits. And so if the banks are telling you these aren't what they want to lend on, it's a good sign that they're not great investments as well. So
yeah, that's a good point. That's a good point
as well.
Mike did make I think a tongue-in-cheek comment. He said, "Rent out a caravan in a mining area." Maybe it's a safer way to get that rental income. So Amir did ask a question which is slightly more technical. So I'm not sure who would be best to answer this one. Probably both of you, but
probably Ben.
Yeah, okay. Just chuck the hard ones to Ben. Is there any way to transfer current mortgage for buying new property while selling the existing one without impacting borrow capacity?
So there is a loan feature called loan portability, which is available with some banks. And that's where you can port your existing loan to a new security in that specific circumstance that Amir has mentioned. Now, I just wanted to note that loan portability is it's not sort of a blanket feature that can be applied to every transaction. And typically, even if it's something that's offered by the banks, it's in very specific circumstances where it's allowed. So, for example, and even if there was it was a very low LVR, so it was a low risk for the banks. And a specific example, for example, if you had a property that's worth $1 million and a loan which is worth 300 grand, so a very low LVR by the bank standards, but you wanted to downsize, for example, and buy an 800K property, and you've got a fixed loan currently, and it would make absolute sense to transfer that to the new property. Now, the banks are going to say, well, even though it's a very low LVR, but the LVR is actually increased because now it's 300K on an 800K property.
Right.
And from our perspective, that's an increase in risk, so we won't allow that loan portability. So even though it's something that could be achievable, it may not be achievable in all circumstances. And the banks are actually quite stringent with the circumstances that they will permit that.
I definitely think it's a real technical, personal question. We absolutely have done it. We absolutely have considering it with clients at the moment, but it's definitely more of a higher risk thing and more likely a big bank's going to offer that rather than smaller lenders. And so, but yeah, if you're thinking about it, check it out with your broker because it's a very technical question, to be honest.
Yeah. This is actually one that I see a lot, mainly from people who have a lot of equity in their home and maybe they're investors as well, like in the stock market, or they have their own business and they could potentially organize to pay off their mortgage, which is, should you keep some money on your loan and keep it there, or just pay it off completely and release the title? Like, do you guys have a preference around that if someone's at the other end where they're thinking of, is there any benefit to that?
Look, I think if you're talking when people are getting to retirement.
Yeah.
Look, it's got to be stepping into potentially even financial advice. And so you definitely want an advisor at this stage of your life.
Absolutely.
If you think about things logically, what you want in retirement is access to cash. You're spending cash. You're not receiving cash, right? And so you need access to cash. And so the more ways you can have cash available, the better. So what we see is a lot of people, when I was doing a lot of advice in this space, is people become asset rich, the house, the investment property, even shares to a certain extent. And then they've got no cash coming in, right? So they have to sell assets. And selling property, for example, is a big lumpy asset to downsize. What you typically want if you're going into retirement is multiple pools to draw money from. And equity in your home could be one of those pools. So you could have $1 million loan with $1 million in the offset account, right? And think about this from a strategy point of view, right? Your share market's down 40%. There's a 2008 scenario. Do you want to sell your super fund? Do you want to sell your share portfolio? You probably don't want to sell your house, but you could have a facility on your house that you could draw down rather than selling assets. And so technically, when you want to get to retirement, you want to have a facility available. You do need to be concerned around the issues with just putting debt on your home and basically accruing debt and just spending all that and then be forced to downsize. So there are risks, but that's much cheaper than a reverse mortgage. If you get to a situation where you want a reverse mortgage, add another 2 or 3% to your rate, plus LVR restrictions, plus the stress of having to refinance those loans and things like that. Whereas the 30-year loan on your home loan. So a big thing I see with people getting to their 50s is they try to get that title. I've got this title on the wall, not that they put in the pool room or anything, but ultimately they've got this title, but they've just butchered themselves on an access to a line of credit, basically, that they could have used in their retirement when as a risk management strategy at all, at least. So
that's a good response.
Yeah,
that's good. So yeah, definitely speak to your advisor for basically even property, but non-property stuff obviously is their expertise. So speak to them. Zach has asked a question, which is a really good one. And I like this one because it might be relevant to me sometime in the near future, which is if you do have a property and you're considering a significant renovation, you've got equity in the property. So you're thinking, well, maybe I can draw some of that equity back out, similar to Selena's question before. And instead of investing in another property, I invest in my current property. So like a loan for a renovation. What should someone consider in that scenario?
Look, there's probably overcapitalization. I think I did that a couple of years ago. And so don't come to me about how to do a renovation smartly. I've probably failed that test now. But ultimately, the key word in this question is significant right now. Is that structural? Is that going to be through a builder? Are we talking, hundreds of thousands of dollars, right? And you've got to be really careful trying to do that out of equity. The problem you can get in is if you do run out of money, renos cost more than you expect. There's lots of things you just won't consider in that cost. And you'd never want to run out of money with a reno. It's not a good situation if you need more money from the bank. There's very little things we can do as brokers. We have to go to horrible lenders. You have to pay big application fees, and you have to pay ridiculous interest rates. And no bank wants to touch it. So the worst thing, if you're doing a significant renovation, you just need to make sure you've got enough cash and you're not going to run out of money with a big buffer to try to do it. So you might want to consider something called a construction loan. There's huge benefits of that. And they'll lend on the end value, assuming it's DA approved. You've got a builder, a fixed price contract. They'll value what it's going to be in post reno, and they'll generally lend up to 80%, sometimes more than that as well, right? If it's just going to be, you're doing the bathrooms and all this sort of stuff, and you want to subcontract it out to lots of different people, you might find that hard to do a building contract on, right? And so you might just need to release equity up to 80%. Then you might want to do another vow, release a bit more equity if it's tight, and do it in stages. Or you might have enough cash to do it in one stage and then you refinance at the end of it, etc. So it's a careful one. That would be my advice.
Yeah. Ben, I remember when I spoke to you, I don't know how many months ago it was, and it was in relation to getting a valuation on our property. How often can you do that?
So with most banks, valuations are valid for a period of 3 months. For some banks, it might be 6 months. And so, typically, I guess every 3 months, that valuation would no longer be valid. And if you want to rely on that, or you want to take out equity, or you want to restructure your loan or carry out a new transaction with the banks, they will typically request for a new valuation. I think one thing to note with valuations is that there is an element of luck with valuations, and it's really based on the particular valuer's skill, experience, whether they're having a good day. And so there is a big element of luck. And I think one strategy, I guess, of managing that is ordering several valuations. And then you've got a range, and I guess you can pick which valuation to utilize to achieve that bigger strategic advantage.
Yeah.
I'll throw a point in there as well. You need to be strategic when you order the val, right? You need to know, because they're going to look at comparables, right? So if you think, it's actually a really good comparable, very similar to my property that's just sold, and you can use that data if it's either been verified on the they need to know about that sale, whether they call the agent or, these actually are sold. So you're best to order it after you get ideally multiple, right? Because then you can argue your valuation if you get any issues. If you haven't got great comparables, your luck, like you said, Ben, if they're having a good day or not. The banks are shooting themselves in the foot here. The banks are moving to something called more desktop valuations, because they're like, it's $200-$300 it costs. I'll just do this thing online. And you can get really lucky with desktop valuations. If I was a bank, I would not be doing any desktop valuations. And so that's just another thing, is that banks sometimes do these desktops, which can come in a lot more than it's actually worth, to be honest. And so, yeah, just be aware of that as well.
The banks might figure that out in a couple of years once they realise how far wrong those things can go. So I've had this process done. Someone comes to your house, it's over in 15 minutes. They look around the house, take some photos, and it's a pretty good thing. But one thing you did tell me, Ben, was that to look at comparable sales just in case in the area. The other thing was to let them know if you've done things. So, we did the bathroom, or this has all been landscaped, and it just might help to achieve the goal that you want from that, which is great. There was a question I realized we skipped over from Selena, which was, if a couple tries to buy a house together, what happens if a partner is a first homeowner but the other already owns a property? How could they make the stamp duty exempt? Like, is that possible if two people come together and one of them has already owned a property?
I think you want to call, if it's a stamp duty concession you're talking about here, definitely contact the Office of State Revenue or whatever it is in the different states, right? Because there's lots of little terms with this. Like the government, for example, on the 5% deposit scheme, changed the rules around that. If you haven't bought a home in the last 10 years, and it was, so it is a bit of a technical thing that you want to find out. There might be a way around it, but if that then potentially does mean you do have to pay stamp duty, but then it means you get a much better property. Sometimes just like going for the carrot, and to save some money on stamp duty, but then you buy a poor, the opportunity cost can dwarf that stamp duty over the period you hold. I do think, and the biggest carrot that, governments used to put in front of first home buyers, and I've been very vocal on this for many years, is it's encouraged people to buy new property. So it's encouraged people, first home buyer grants if you buy new property, etc. And the governments know it. They make massive money on new property, and they've been stitching up first home buyers for years, making them buy the poorest assets because they fall for the benefit. And so just be really careful over focusing on this benefit when, so if you can't get it because of your state, that doesn't mean you shouldn't still buy together. Hopefully that helps.
Yeah. Just one thing, we've still got about 10 minutes to go, everyone. So if you do have your questions, please send them in. Thanks for answering that one, Chris. I can see a few of you have already responded to that. Whether you're watching on LinkedIn, Facebook, or YouTube, please send them over. You can send that in the comment or chat function. So Max has asked a question. What is wiser when upgrading the residential home? Buy a larger and rent out the existing, or sell the existing to reduce the loan requirement for the next home? This is actually a really good question. This is the upgrader part, which we haven't really got to, which is the idea of, like, you might have your first home, but then you want the family home to, maybe not forever home, but maybe it's the home that you've settled down in for a decade or two. This is a question I've got to admit that, like, I'm at, right? Like,
yeah.
I had my old man around the other day. I'm saying, we probably want to add an extra bedroom. And then he's like, just move. He's like, just move. He's like, why would you? So, and he's a tradie. So maybe that's where he's coming from.
Yeah, he knows that he's got to build it for you. Maximilian, it's a really good question, right? Now, interest rates play a big part in this, right? Ultimately, though, the issue we see with this is the first property, your home, usually you build a lot of equity up in it, right? And so that loan's got low tax deductible debt. And then when you try to keep it, it's really hard because you then go and upgrade your home and you take on this big non-deductible debt. This is getting a bit technical for some people.
No, it's good.
With this situation is you've got, and especially under higher interest rates, that means you've got a big non-deductible debt on a high interest rate. Your cash flow is going to start burning. And it also doesn't make sense long-term. And the other benefit of selling your home in this situation is you probably lived in it and it's growing tax-free. So what you do is you can sell your home tax-free with a low tax deductible debt, pay off your new property which would have a big non-deductible debt on it. And then you're potentially better to buy in the market again, even though you pay stamp duty again, your selling costs. However, that doesn't mean you should do it straight away. Markets move in different cycles, right? And so sometimes it makes sense to do your upgrade, keep your existing. You've got to have good servicing for this. So Max, you're going to need a decent income to pull this off. And then you hold your existing asset for a short period to maximize its sale price and get a bit of arbitrage where you've bought in a better market and then you sell in a better market and then you do that trade in a few years. You may say that justifies the interest cost. But ultimately, it's really hard when people are doing upgrades, especially if they've got a lot of equity in it, to not justify selling, paying off the new home, and then buying another investment that you then hold for a long period that's fully tax deductible, then gives you a much better cash flow situation, much lower debt, etc. So hopefully that answers your question. Like ultimately, if you then sold your home, you paid off that a lot, then you've got more capacity again, because that's why the only way you can consider this strategy, you probably would go and buy an investment at some point. So it's not mean you're never going to buy an investment property. You've got to be careful, be too much emotionally attached to this as well. Just because you had the home and it worked for you over that period, because you can sell it CGT free, sometimes it's better just to let it go. Even though in your head, you think it's a great asset. Well, there's lots of great assets in the marketplace. Sometimes you just got to cut that cord and let go of that emotional attachment.
I got to admit that's something that I think about a lot, right? Because like you invest, if you've got your first home, you typically invest some time and love into it, and you think I'm going to hold this forever. It's a good property, whatever, sure. But then you think to yourself, well, actually, when the push comes to shove, it doesn't make sense to keep this thing if I need to get there. And so, yeah, that's a great question. And upgraders, I know you guys deal with a lot at Blusk. So feel free to follow up with Chris and Ben and the team after this as well, because I think if you can see from Chris's language there with deductible loans, non-deductible, but also the calculations around cost, it's probably just involves a little bit of spreadsheet work there as well. QTech says, buy a house in your personal names or under family trust and have your family members in the trust. This is a technical structuring question from QT Life.
This is definitely tax advice.
Yeah.
Now, I probably wouldn't want to talk about this on a podcast like this, etc. Look, you've got to be really careful talking to accountants around this as well, right? You walk into an accountant's office and say, do you want to buy it in a home, in personal, or a trust? A trust is a product. A trust is something they can charge you to service, right? It's the same as if you go in there with a super fund and say, hey, should I have set up a self-managed super fund? They'll go, well, yeah, if you want to, right? So you've got to be careful. Now, there are trusted accountants out there. This is not dishing out on accountants, right? But you just got to be careful, right? Because we have seen in the property space and people encouraging people to go set up trusts because it's the cool thing to do in property, but there's very little benefit. And when you really think about it, there's issues with negative gearing, there's issues with distributing income, there's issues with borrowing, etc. So just be careful around this thing, getting the advice from the right person. And it is tax advice, so you do need to get tax advice on this.
Some financial advisors can also help you if they're tax advisors. So they can be financial advisors, QT Life, but also have a tax qualification, which is a separate tick that they have to get. They won't set up the trust for you. That would be the accountant, but they can at least help you navigate this circumstance. And I think what Chris is basically saying is get maybe multiple opinions. If you are so convinced in this strategy that someone's told you about, get a second opinion, speak to some trusted advisors on this, because it's a good one.
Typically as well, if you're talking high-end loans, you're talking big corporates, your business owners, you've got a high-risk profession, there's lots of things that not accountants do, but actually tax lawyers can do to get a bit smart with stuff, right? And try to minimize your estate planning risk and your asset protection and stuff like that. So
there's a lot of
significant assets. There's things that, are very technical, and you need to be speaking to tax lawyers, to be honest.
Yeah, there's some really good tax lawyers around. They work around the country, even if they're not in your city. So have a look around there. They're all around. Okay, Dan says, can it be worthwhile to buy in a location we plan to move in a few years, with the property being initially an investment, then becoming a principal place of residence, so their home, in a few years? So I think this is a question around, do you see, we talked about the portability of loan before, like how is it in, you guys are not here to give tax advice, but how does it kind of work from it was an investment, but that was 3 years ago. I've been living in it for 2 years. Like, how does that work?
Dan, it's something that we're massive fans of, right? Now, we've got to talk through what the pros and cons of anything is, right? Why I like this strategy is you're sort of thinking longer term. You're sort of thinking, I'm buying for my future, right? I'm not buying for my current needs today. And that's the way you should be thinking about properties. You've got to try to think, like, I want to get something I get a long runway in. Like if you're in a rental property and you go, I just want to rent stead money, I just want to buy an apartment. Well, that's mainly short term. You may just meet a partner and you want a house and family and all that sort of stuff. So what I like about this question is you're thinking longer term. Now, you can definitely buy it as an investment property, rent it out, and then move into it, change it to an owner-occupier loan, get yourself on a better rate. And there's no real tax issues with doing that. It just becomes a deduction in your tax return. There is a potential issue where you might pay capital gains tax on those first few years when you sell it one day because it was an investment, but then you lived in it. The other thing you might not be eligible is something called the 6-year rule, where if you moved into, when you buy a property and you move into it straight away, it's your principal place of residence, then you can turn it to an investment property if you haven't got another home. So that's one of the consequences of that strategy. But absolutely, if you, instead of buying what your needs are today, you buy what you need in the future. Particularly, and that's a great idea. If, instead of buying, like an apartment today, you buy a house in an area you don't want to live in today. You're in the city life, you've got a partner, you don't really want to move, and commute. That's really when you get to the family stage. So you buy a great block of land that you may want to live in the future. You've got a good idea that that's where you want to be. And then you move in there and then you renovate in the future, right?
Yeah.
So great question, Dan. It's a good strategy we often consider.
We've got a couple of minutes left, so we've probably got time for one or two more. But I'm just going to follow this up with Ben. Yeah, probably one amount that we talk. But just Ben, in a situation where someone does buy a property for an investment property that they may want to move into in the future, would they need to get an property like an investment loan first? But then do they have to change the structure of that loan later down the track, or should they?
Well, it definitely would be beneficial to change it to an owner-occupier purpose because you'll get a better rate.
Right.
And you can definitely do that. I think the banks are aware that when it comes to property, the intent and the use of the property, it changes quite frequently. So most banks will allow for the conversion of an investment loan to an owner-occupier loan without a reassessment. With typical just evidence that you are currently living in it. So, for example, showing, an electrical bill or rates notice. Some banks will require for you to have lived in the property for a minimum of 6 months before you can do that. But it certainly is possible, and we certainly recommend it because you're going to get a better rate.
Okay, well, that's I think that's just about all we've got time for today. There were some questions that have come through, but thank you everyone who came along. You can get in contact with Chris, Ben, the team, Giovanni at Blusk. They're actually, I was just checking, I did put a link below in the video below, so you can find out more about how to work with these guys. And Chris obviously appears on the Australian Property Podcast. He's repping the merch today. There it is right there. So every Sunday morning, you can catch Chris and Pete talking about all things property. 20,000 listeners to that already, Chris. So kudos to you and you, Pete, Amy. Awesome work. And Ben, obviously, if you work with Blusk, you'll probably come across him multiple times like I have. So it's always a pleasure to chat to you guys. And thank you to everyone who did attend the session today. If you liked it, please let us know. Let us know what you liked about it, even here right now in the comments. We'd love your feedback because we're happy to do more of these. We love chatting to people. We love answering questions, particularly right now when my belief is people need help right now and they need the guidance. So if you like it, share it with your friends and your family members or your partner, watch it back. And we can do more of them if you want it. That's why we're here. So that's about it. Thank you, JD. Thanks, Mike, Dan, everyone, Max, Selena, everyone who came with their questions today. It was really great. Get in contact with the guys at Blusk using the link in the description below. And Ben, Chris, fellas, thanks for taking some time out of your day. It's been good fun.
Thanks for having us.
Indeed. Thanks, Owen. Thanks, everyone.
Thanks so much, Owen.